All right, we have a fantastic session that follows up perfectly. Three people who joined the Assistant Treasurer on the insurance delegation to London, Munich and Zurich just a couple of weeks ago. Now, this session offers a global perspective from two of the world leading reinsurers on the big trends shaping our world: geopolitical volatility, inflationary pressures, climate change, rapid digitalisation and AI. And we want to particularly dive into the insurance protection gap across markets and ask, what is the role of reinsurance in navigating all this volatility? So I should be joined by Scott Hawkins, Managing Director of Munich Re Australia. Where are you, Scott? How are you? Give him a round of applause. Alix Pearce is with us, General Manager, Climate and Social Policy and International Engagement at the Insurance Council. Hi, Alix. Good to see you. And do we have a third panellist in the room? Trent, Thomson, CEO, Australia and New Zealand Swiss Re. Yes, there you are. Come on down. Thanks so much. So I'm interested to hear from the reinsurers just their reflections on what the Minister had to say in terms of the scope of ambition for mitigation and reform in Australia, because of course that would be of particular interest to reinsurers in terms of the scope of the risk and the extent to which Australia is moving towards what Alix will talk to us about, which is being a world leader in risk mitigation. What did you hear, both gentlemen?
So maybe I can jump in. So first of all, when we look at as global providers of capital, reinsurers, we look at Australia and we see Australia as a very well diversified country to invest in. Right? When you have the US insurance market, 50% of the global insurance market, global capital providers are always looking to how we can diversify risk. So Australia is naturally an advantageous country to put our risk capital in if the conditions are met. So to that end, when having the Minister over with a delegation, I think was very positive in terms of the impression he gave us. There are, as he mentioned, the Hazards Insurance Partnership is a world-leading collaboration between the industry and government in terms of how do we tackle this together. When we look at the global insurance protection gap. So we talked about this yesterday. We talked about, and the insurance protection gap is, for those that don't know, is just the gap between the total economic losses from disasters and the total insured losses from a disaster. And last year, Swiss Re estimated that the global insurance protection gap is about $1.83 trillion. It's very large. And as we did that survey and we did that study, we looked at different individual countries. And what we found was that Australia is probably the third lowest when it comes to protection gap globally. So Australia is a highly insured nation, which is fantastic. And when we talk about insurance, the role insurance plays economically for a nation, and we talk about the resilience of a nation, there is a direct correlation between those two things. So Australia is well placed. But let's be clear, the protection gap, for China is 94%.
Right.
For India, it's 91%. For US, it's 43%. For Germany, 57%. For Australia, it's 33%. So if I said to you that a 33% protection gap is some of the world's best in terms of a small protection gap, I think most of us would say, we can still do a lot more. And I think the key message that Minister Molino certainly delivered is the government's willingness to be part of that solution. The way that we reduce our protection gap more here locally is through public-private partnership. It is through balance to try to how do we reach those high-risk areas and how do we do it in a balanced way alongside resilient investment to reduce the risk. So that's what I took away from the delegation, a partnership mindset, and global capital will always follow a nation that has a long-term plan and a long-term commitment to reducing risk and making their citizens more insurable.
And similarly, Scott, not only what you heard on the delegation, but what you heard today in terms of the, yes, a long-term vision for this, but are you comfortable with the pace that the Minister seemed to be indicating he wanted to proceed at?
Thanks, Ellen. I guess this is a really hard one, and I don't want to sound like a politician, but the problem that we have to solve is enormous. And so, of course, everyone in this room would like to see things happen quicker. but there's some practicalities that come with that. So what I think is really good, what the Minister is saying, is very much the increased commitment from government to spend money on resilience and mitigation, because that's what we need. I think the thoughtfulness that the Minister goes through in not wanting to quickly introduce something without really knowing that it'll have the benefit that's desired is really important for us as an industry. And I think from my discussions with the Minister, I think one thing that's vitally important is that we focus on increasing accessibility to insurance for those who don't currently have it versus just making it slightly more affordable for those who already have it. I think we need to bear in mind that the people that we're talking about are buying properties not because they know of the risk that's surrounding the property, but often because that's the property they can afford.
Correct. Correct. And therefore what?
And therefore, we need to do everything we can to help those people access insurance. And really, one way that we can think about this is to say, we need to know exactly what the right price is for the risk. So that's kind of a given. That's what we all do. We then need to say, what does that mean? What's the cost of that? We need to have an overlay of how much could people actually afford to pay in those areas. And as the Minister said, and as the Insurance Council have also come out with, is if you look at the socioeconomics versus those who can afford insurance, obviously some of the poorest people live in the highest risk areas. So once we know where that is, once we know what the cost is, then the country needs to make a decision as to how do we fund that. Because it's clear it's often not going to be those individuals who can fund that themselves at a risk-based price.
And do you think, based on what you've heard, that there is an understanding that there needs to be a long-term project, investment and collaboration with industry to achieve exactly that, a shared risk pool for flood?
Whether it's a shared risk pool for flood or whether it's a different sort of funding mechanism. So for me, I wouldn't be jumping straight to what's the right solution before we've defined exactly the problem and the quantum of the problem. It may well be that one of the most important things is to move properties from the highest risk areas, and that will have a bigger impact almost than anything else. The other one is don't build properties in areas where we shouldn't build properties.
That's right.
Because we can't change often where things are, and as a country we couldn't afford to buy back every property that's exposed to that at extreme risk. But what we can do is make sure we don't make that problem worse and try and come up with a community-wide, country-wide solution for those who definitely can't afford insurance.
Alix, I'm interested to hear you reflect, as you did in the Australian Financial Review this week, about the conclusions and learnings from your Churchill report launched this week. What does it tell us about how the Australian insurance industry actually can work with government to progress this, dealing with this gap?
Nice plug, Ellen. Thank you. Your cheque is in the mail. Yes, I was really fortunate to be funded by the Winston Churchill Trust to go to 6 countries around the world this year to look at this global challenge, which everyone is struggling with, right? That insurance is increasingly becoming unaffordable for those living in high-risk areas. And I think a few things were really clear to me. The first is that Australia is very much on the front line of hazard risk. The Minister quoted our catastrophe report that we launched this week, which shows that Australia is actually shouldering some of the biggest costs from disasters per capita out of any other nation globally. But the flip side to that is we're also one of the developed economies with the best capacity to adapt. And we actually have a lot to be proud of, as Trent's reflected on. The Hazard Insurance Partnership is world leading. We have state resilience programs that we heard about yesterday, which other countries are actually sitting up and taking notes about. And we're also one of the first markets anywhere in the world to reward household resilience with premium discounting. And that stuff really matters and leaves us really well placed to be a resilient superpower and an exporter of that disaster risk expertise. And I think that that's really important in the context of this panel because we are undoubtedly entering one of our riskiest decades to date. So the macroeconomic challenges that we're facing into are compounding like never before. We've got economic volatility, we've got geopolitical volatility, we've got extreme weather getting worse, but also that exposure to those risks is climbing. More and more people are getting put in dumb places and in harm's way. So how do we solve for that? There is no silver bullet. I think that our resilience credentials are really critical because we are competing for capital in the global market. So what we do as an industry and what we do with government matters. That matters for how we compete for that capital. And in terms of the solutions that we implement, part of that absolutely is a gold class public-private partnership between industry and government to solve for this challenge. But it also comes with a whole package of other measures that we've heard about over the last few days. Land use planning, a really clear hazard baseline. It's a full policy toolkit that we'll need to implement to solve.
I feel like Andrew Hall has taken me on an education process that over many years, and even somebody as dumb as me understands that that's the scope of the problem. Yeah. How is this discussion developing? Yes, we're seeing the premium discounts, we're seeing the impacts, right? You're seeing some back and forth between action and reaction. But how is it developing? Because in Australia we do tend to have an instinct to really admire a problem from every different angle, you know?
I think actually, Ellen, we're at a critical inflection point for our industry when we look into this challenge, but I do think the stars are aligning. So what I've seen, sort of there's 3 golden rules, I think, globally that we now are really well placed to implement here. The first is when it comes to a public-private partnership, you absolutely must have a significant amount of public resilience investment that sits alongside any risk pool. It needs to be publicly funded and it needs to be backed by a national disaster risk profile of current and future risks. So we can all agree.
That's the data piece.
That's the data piece. So we can all agree collectively, okay, these are where the high risk areas are in the country. Therefore, that's where we target the resilience investment. This is not some pie-in-the-sky fantasy dream. We've seen this in the Netherlands, for example, where it exists. In addition to that, it then needs to be underpinned by really clear, legally enforceable land use planning rules. And this exists in places like France and in Norway. So if there's a disaster, you cannot just build back. You have to have approval to rebuild in those locations. And not only that, you then have to ensure you rebuild to higher standards that match up to the disaster that just happened. So that's a really clear kind of couple of principles that we know are really important to apply here. And we've got the momentum now. We have the hazard insurance partnership. We have a really talented minister who understands the size of this challenge. And we have a collective ecosystem of experts in this room that are leaning in to solve for it.
Well, she's very positive. That's good. I'm glad. Let's then go to Scott. Can you talk about, from your perspective, from the reinsurance perspective, how do you think disasters are evolving? Because part of what Alix is saying and what the Minister was saying as well is we've got to solve for, 2100, not for 1999.
So if I think about how disasters are evolving, I think we instantly tend to jump to climate. And I'd probably say climate would be the third part that I'd go to, because it's the harder one to say what's happening now. So the first two, we know what's happening now. We know where we build, and we know that inflation, and there's various forms of why that's happening, is actually making those properties more expensive. So we know anyway, if the same event happens in the same place today, or in 5 years, it will cost more, just simply because of inflation. So that's one driver of costs. The other driver is how we build. So we also know that if we build in the wrong way, in the wrong place, the cost to rebuild it will be even more, because it will be more damaged than if it was built correctly. The third one is we know that the climate is changing, and therefore we're having more frequent disasters, and we're having them in areas where we haven't had them to the same extent in the past. So those 3 factors are saying we do not think that the scale will only get bigger, not smaller. But it's not just climate. It's all of those 3 factors that are driving the increases.
Trent, can I turn to you? In terms of, allocation of capital, you're saying Australia's doing well. That's good. But what could we do better? What could we do to make ourselves more attractive to capital providers?
Yeah, so I'd say there's probably just 2 other factors I'd jump in on.
Okay.
I'd also say that the populations around the world are tending to move towards places which are more exposed to secondary perils. So, in Australia, it's up towards Queensland. In the US, it's towards Florida. So we're inviting more population to go into those areas where there's going to be those losses with more frequency. And the second is just increased urbanisation. You know, we are concentrating our populations in smaller areas, so when we do have events, we are having much larger severity of costs. The long-term severity of cost is going up 5 to 7% annually, and as Scott and I were probably 6-7 years ago, we're saying over $100 billion is the annual, and now it's around $145 billion. And so that is also concentrating reinsurance capital, because the reinsurers are taking up larger parts of that event loss on an annual basis. So if we talk about capital providers, as I said before, Australia has that natural diversifier in terms of that attractiveness. In terms of how do we make sure that we keep global capital coming to Australia, as I said also before, the Hazards Insurance Partnership, the belief in the government in terms of having its hand also in terms of long-term risk reduction in the environment. The challenge that we've had as global reinsurers with this region is Australia has been probably the poorest region in terms of performance over the last decade, and that's largely because of the 2017 to 2022 large uptick in frequency of those secondary perils that we did see come through to Australia, which was very atypical compared to the last 30 years. So it surprised us all, insurers and reinsurers alike, and so we had to readjust our risk models accordingly. So it's about understanding data. It's about getting, as we start to invest in resilience and risk reduction alongside the government, it's very much around making sure that that data and that effect is being transparently communicated with reinsurers, so we can then reflect that. You know, our models are getting to the point where we can start to, much more sophisticated way, be able to put flood levies into certain parts of Australia, be able to show that ROI of that flood levy, and also then make sure that we adjust our pricing on a prospective basis around that. Now, it's really clear to say also that the majority of some of those savings would come through the insurance premium more than the reinsurance premium. Reinsurance premium is only about 10 to 12% of an insurance premium. So large increases and decreases in that reinsurance premium doesn't dramatically change the insurance premium, but long-term, global capital, there's a strong reliance on global capital here in Australia for reinsurance. To give you an idea, if reinsurance disappeared tomorrow, insurers in Australia, this is from the Actuaries Institute report, which Kate Bible did a great job on, and the team. But if reinsurance disappeared tomorrow, insurers would have to recapitalise an additional $23 billion to make the minimum capital requirements. And to get back to the solvency that they share today, they would have to recapitalise an extra $70 billion. And to give you an idea, the insurance industry today is about $34 billion. So it really shows the magnitude of how much reinsurance capital supports the Australian economy. From a Swiss Re perspective, we have about $5.5 billion of our capital exposed each and every day to Australia and on a per event basis. So that gives you a sense of the magnitude. Munich Re also, one of the market leaders here, would have something similar as well.
Sorry, Alix?
I was going to add, the other climate driver that we're seeing that's interesting is this rise of what Trent referred to secondary perils, because we love terrible names for things in the insurance industry. But that's sort of it's not your big events that have the catastrophic losses, like your earthquakes, for example. It's bushfires, it's severe convective storms like we saw in 2022 that stick around and dump really intense rain for a lot longer. So this trend we're seeing of this rise of secondary perils is that they're now becoming primary as well. And it's this death by 1,000 cuts effect. So we're no longer waiting for this one major massive event. It's actually compounding events hitting again and again and again. And that's where investing in Australia's data capabilities is really important, to be able to better track and understand those secondary perils too.
And so, Scott, thinking about that then, what does that mean for the insurability of these events and the role of reinsurance? If, what we're also hearing is the nature of what we're facing is changing. Yes, you've sort of brought us back to tin tacks with where do we build and what does that look like? But if the nature of what we're facing is changing, how does that affect insurability?
Yep. So maybe I'd put that into two contexts. One is, what's reinsurance there for? So reinsurance is there to take volatility away from insurance companies because we do it globally, and so we can aggregate that volatility. So that's kind of the reinsurance element. So if it becomes more volatile, we can absorb the increased volatility. What we need to remember, though, is what we would call the expected loss in the industry, or on average what you expect every year. If that goes up, that's not volatility. That's just the losses that everyone needs to pay. And that's more of an insurance issue than it is a reinsurance issue. In terms of insurability, for me, the topic is more one of affordability than insurability. And secondly, does it make sense for the economy? So if you use, one example would be, if a house was going to flood every 4 years and the person could afford to pay a 1 in 4 year premium,
Yes.
does it make sense for the economy to continue to rebuild that property in the same place? I would say no, it doesn't. So that's one element. The other one would be, as things become worse, it's really that the people are going to be less and less likely to be able to afford the insurance in the first place, which is, again, not so much of, I mean, apart from a business model perspective, not a reinsurance topic, but it is a country topic.
Yes.
Because if people can't afford insurance and their property's damaged, well, we're not going to leave them in the lurch. So when we talk about insurability or affordability, I think what we're really talking about is who pays in the end. Is it the policyholder? Is it the government? Is it the taxpayer? Is it the funder of those properties, being the banking sector? So I think that's what we need to focus on, because then we're going to have a good building stock. We're going to have one where most people could afford insurance. I think we're always going to need, going forward, some sort of scheme to help the most vulnerable in the community, because if a family has an income of $40,000 a year, they can't afford $2,000 in insurance. So you're never going to be able to make that resilient enough to make it affordable. So I think the insurability is really what we need to focus on, and having more people insured, whether it be in the private sector, whether it be in the public sector, or be a combination of the two.
Some great, who pays in the end? That's a great way to frame it, isn't it? It's who pays in the end? Because someone's going to pay
Yes.
in the end.
The losses are still there.
Yeah. Some great questions coming through. Keep them coming through on the iPad. This is a really interesting one. Betterment or buyback of homes post-event means insurance is the funding mechanism for resilience. What does that mean for reinsurance?
So I'm happy to take it, Trent. So I guess, again, that comes back to the funding element. So if part of an insurance policy is to say that post-event, what you build is different to what was there before, and that will cost more, well then that's for us to then put into our pricing models to say, if the property currently, let's call it, has a sum insured of 500,000, but if there was a loss, it's going to be $1 million, well then we would factor that into our modelling and charge the premium appropriately, as the primary insurer would be doing as well. So it's not something that reinsurers would run away from. They would say, what's the data transparency? What would be the case of being what's built back, and therefore we would price it accordingly.
And I'd probably just say that the betterment element, the betterment dimension, when it comes to a large risk, largely falls to a reinsurer, because insurers only have a fixed exposure to a per event basis. Reinsurers vastly cover most of the natural disasters, so that betterment dimension is something that we absolutely have to price and be aware of. And it's been tricky because the building codes have been moving so much over the past few years. So it's a tough one to model accurately, but we make assumptions on our pricing.
Insurers are stepping up to recognise resilience for their customers. Will reinsurers incentivising or recognising insurers' actions in RI agreements?
I would say we already do. So when we reprice the contracts, we already know where the risks are and where they change, and therefore that's reflected in the pricing. If we know that the resilience of the properties are better or worse, that's reflected in the pricing. So I don't think that's something that we need to change. That's something that we already do and have always done.
Except that, Alix, when you are talking about data, you're talking always about a strong, targeted, evidence-based practice, and as much transparency about the data as you can get. Here's another question. Should we have a nationwide buildings risk resilience database that's open to all Australians? So yes, we've got the shared information between insurers and government, but in terms of stopping the dumb things, surely the more transparency, the better.
100%. A national asset register for this country would go a long way in helping not just our understanding of hazard risk, but also assisting us in understanding where to target some of those solutions. I'm pretty jealous. When I went to the Netherlands, I met with their flood commissioner, who I like to call Poseidon, but he has a very good view, a good sense of all of the flood risk, because over 60% of the population lives below sea level. And they have a national hazard baseline for the entire country and a national asset register for the whole country as well. And they can see live in real time all of their infrastructure, how it's maintained, how is it impacted by disaster, and they spend €1 billion a year targeting and maintaining that flood defence infrastructure over time. And that has enabled them to become one of the world's leaders in flood resilience and disaster. So data is absolutely the spine that underpins all of that.
And the fact that households could see it, because that seems to me to be, there's friction on that edge there, isn't it, of, and Janelle Saffin was talking about, remember how language is important?
Yeah.
So she was saying, okay, well, let's not, floodwaters are rising, let's not have a debate about climate change. Do we accept that things are getting worse, and, you know, and what language are we going to use with people? So I wonder to what, you know, and again, I keep coming back to that Logan experience of the shock of flood maps. So you're doing the flood mapping and it's a shock. Whether or not we need to sort of rethink how that information is available to people.
Definitely. There's absolutely a role for us to have hazard risk disclosed before you buy a house or before you sign a lease, to understand, well, is this property going to be very exposed to flood or to fire? And look, to Scott's point, there'll be some vulnerable Australians that live in the highest risk area, and it's because it's not a choice. It's the only place they can afford. And so they need a different set of policy solutions to solve for that challenge. But there's a large amount of Australians living in areas of medium risk that absolutely would make different decisions if that risk was disclosed. In the US, they have this. One of the biggest real estate websites in the country, you can type in the address and it will tell you exactly online if you've got flood risk, fire risk or cyclone risk. And that's a really important tool that we could see adopted here in Australia.
I mean, in New Zealand, you can see through the NHC actually past claims of your property that have been put with the
Really?
NHC. Yes, it's an area. I think one thing where I'd see Australia is maybe different to the US. Of course, we don't have non-recourse lending in Australia. So I think one of the reasons why there's some hesitation to really publicise the level of risk of individual properties is what would happen to valuations potentially.
Of course.
Which is then moving also the problem, which is just the way it would be, moving the problem from there to the banking sector,
and that's,
which then has a superannuation impact and a stock market impact.
Yeah.
It doesn't mean it shouldn't be done. It just means we need to think of also, a bit like, as the Minister said, what are the consequences of some things and what would the pathway to be to get there? It's not necessarily that you can change from Friday to Monday and then just announce.
Okay, there's a question here about the role of banks. The question has not been written in all capitals, but it could have been written in all capitals. What about the role of the banks when it comes to, quote, stopping the dumb things? How do we engage the banking sector in the discussion of asset risk? Maybe this is one for our regulators a little later as well.
So over the years, I have engaged with banks many times about this risk. And for me, and apologies to those who are from the banking industry in the room, I would say banks more look backwards than forwards. So if you think about how banks model their loan portfolio, it's normally on two dimensions. The probability of default, which is largely a credit type measure, and then loss given default. So what losses have they actually seen versus what they expected? Now, in reality, the banks haven't seen losses from non-insurance, and therefore it's not really making it into their modelling. So maybe my ask to the regulators in the room would be that we could do a little bit more to actually work with the banks to say what actually could happen, which is probably more a scenario-based analysis than a stochastic one, which is done now. Because I am convinced that at some point we will have a concentration of properties being underwritten by banks, which will then have a huge devaluation or potentially not rebuilt, and then that will then fall onto the banking sector.
Okay.
And that's already happening. So in the UK, in Canada, in France, major lenders are saying, we won't give you a home loan because we think the risk is too high. And in fact, we think that that property is going to become uninsurable over time. So this challenge is already here. The flood re-scheme in the UK, we heard from Martin Lennon yesterday, one of the drivers for setting that up is because of that mortgage risk and the challenge they were having with getting financing. What to do for that? I mean, Scott, there you go. You've called out an APRA stress test for the banks. I'm sure they'll love you for that. But I think there's also a role for us to work with the banking sector to help build that shared view of risk. So again, we're all singing from the same song sheet in terms of where are the challenges so we can target the solutions.
And I think to be totally transparent and fair to the banking sector, most of the large banks now have climate teams embedded in their risk management functions.
Except that there is this broader kind of implicit agreement between consumers and institutions of don't ask, don't tell, because of the impact of actually what the numbers might say in terms of devaluation and the impact, the broader impacts. Any thoughts on that, Trent?
Just that we've been working with the banks in terms of them, talking to them about how to help them understand their mortgage portfolio a little bit more deeper as well. So I think they're on the journey for sure, but I agree, it's still a missing dimension in terms of the whole value chain of how we're trying to make Australia more resilient.
Maybe we've answered this. Liability concerns may be the reason for lack of flood risk transparency. How's this dealt with in any other countries? Do you have any sense of that?
I think we've covered it pretty well,
Yeah,
right?
okay.
It's a consistent challenge.
Okay, and last one, and then I want to come back to the most innovative things that you saw on your, 11-city, 6-country tour, which I don't think anybody is jealous of. That's how many days did you do that over?
2 months?
Okay. No, but the one with the minister.
No, the one with
Oh,
the
that was
minister,
3 days.
That was 3 days, and it wasn't
That's horrible.
3 days, 3 cities.
Yeah, okay. 3 days,
3
3
days,
cities.
3 cities.
You only did London and a couple of... You're okay. Has the industry and other systems created moral hazard, i.e. complacency to risk? And if so, what do solutions to that challenge look like?
I mean, we've seen that, again, not to keep picking on the UK, but it's just current in my mind because of the flood re-scheme. But they had a challenge where the flood re-scheme subsidises your insurance premium. So they were offering people in the UK to say, hey, you can have a Build Back Better option. We'll pay £10,000 to help towards that, to help you rebuild. And, raise your utilities above the flood line, for example. And consumers in the UK were actually turning that down and saying, A, that looks ugly, I don't want to do that, but also B, why do I need to? My insurance is affordable. So I think there is an important piece of the puzzle here that premiums provide a risk signal. And when you switch that risk signal off, you need to replace it with something around risk literacy. Otherwise, you are going to see that under-subscription of resilience programs and that lack of awareness of flood risk, which is now considerably lower in the UK because of the flood risk scheme.
Yeah. And ditto for California and the fires and Pacific Palisades and the sort of where people were building, just in hindsight seems crazy.
So I think, Ellen, it comes back to what we were saying earlier, that really it's about knowing what the right cost is and then deciding how to fund it for some people.
Yeah, okay. All right, so in terms of 3 cities, 3 days? Brutal. Not a travel day in between. What were the greatest insights that you had in travelling around with the minister, whether it was reflections of the Australian delegation or examples that you were seeing that you brought back and that really made an impact on you, each of you?
I thought the spirit of Team Australia was very impressive in terms of the CEOs being present as well and fully across the issues and very much how do we solve this issue together. And so I think that was very clearly seen, very well observed, uniquely aligned in that sense, in that industry and government haven't always... We talk to many governments around the world and there is a challenge at the moment. As I said before, their protection gaps are sometimes even greater, so they've got bigger issues. But you do see that chasm between private sector and public sector and the willingness to solve issues together. So I think we've definitely crossed that bridge, which I think is super important for the nation's resilience. I think as I was there, I wasn't in the Munich delegation, I was in the London and the Zurich, but I really enjoyed the commonality of experience between the different markets expressed, the similar challenges that we've talked about already. I think when it comes to innovation, when it comes to how do we solve this, whether it's a risk pool or whether it's a private pool, or, as I say, the emphasis here really is on risk reduction, sustainable build-in and smart policy over the medium term, regardless of what the shape of that outcome looks like. But what I particularly liked is Minister Merlino's understanding of the industry, very deep, and so the questions were very reflective of that knowledge, and I think we've made a lot of progress over those couple of days because of that dialogue. In terms of parametric, came up a few times in terms of how to utilise parametric insurance moving forward, and we certainly, Swiss Re, we work with emerging countries mainly because of that protection gap, and how do you come in with lighter, leaner, more direct, nat cat coverages that help governments recover quicker and also help communities recover quicker. I think that's an element there that is something that Australia does use on the commercial side more through captives. But I think it's an interesting dimension as the parametric product continues to evolve at pace. We're seeing a lot of applications worldwide around how we're helping local councils, state governments, federal governments as well, in terms of thinking about their own recovery and the speed of coming in and helping reduce some of those losses by injecting immediate liquidity of funds so they can respond quicker. And we're also seeing it a little bit on the personal line space, but again, we have to walk that path a little cautiously here because of the basis risk. So there is a little bit of innovation. I'd say that to Steve's challenge yesterday, there's an opportunity for more challenge and more innovation moving forward in our space. I think the other thematic very quickly for me was digitisation, AI, talking about how AI, we should be able to bend the cost curve. There is something like $260 billion within the insurance sector being invested annually into AI at the moment. So, I know there's some question marks as to what that looks like, but it's pretty clear that, insurance, when it comes to the cost output curve, the costs tend to go up through scale because of the lag in productivity. And so the AI allows us to really bend that curve and potentially, we fully expect to be able to deliver more efficient, more cost-effective outcomes at a reinsurance basis, but also at an insurance basis for consumers.
I would say one thing that really struck me was just that Australia offers some of the most comprehensive insurance. And by that I mean generally very low deductibles. Generally your insurer will manage your claim end to end, will help to rebuild your property. Whereas other markets, like in the US, for example, and some countries in Europe, they tend to trend towards just cash settling. And that can be challenging, particularly for vulnerable consumers, to receive a whole heap of cash after a disaster and then not have that support to then build back and recover. And so that approach can come with higher costs, but I also think that there's not an appetite to strip that back and trend towards cash settlement, and that kind of gold standard should be maintained. I think the other thing we haven't covered that really struck me was just that when you have a hammer, everything looks like a nail. Because we're an insurance delegation, okay, let's throw some insurance solutions on the table to solve for them. But actually in some cases, the answer to these challenges isn't an insurance one, it is things we've talked about, like buying back the highest risk properties, removing them from the risk pool altogether. And so I think we can be really clear-eyed about what's in the remit for insurers to solve and what sits apart in other parts of the economy.
I mean, I think one clear takeaway is no one came away saying, and there's the silver bullet that works perfectly. It doesn't exist, and maybe if it exists for one country, it doesn't mean it applies equally for any other country. I think for the Minister, I think a couple of takeaways I would see for him on his behalf would be, I think he saw Australia as a net positive in terms of what it's doing compared to others in terms of resilience and mitigation. I'm hoping that he saw a real team spirit for the industry wanting to actually help in providing a solution. And my reflection talking to him was that he also sees that this isn't a problem that the insurance industry created for itself. It's one that's rather landed on their laps, and that he also understands it's not for the insurance industry to solve it by themselves.
Gee, that was a fascinating discussion. Please thank the panellists so much for that. Alix, Scott and Trent. It's time now for morning tea. Thanks again to Sum Insured and RIC Solutions for keeping us caffeinated, and I'll see you back here at 10:45. Thanks.